today, our focus is to go through the government assistance program, whatever the program you have in mind, and to kind of summarize how that impacts your 2020 financial statement. When I say financial statement, I am talking about the income statement balance sheet, how they come in, where you use that to file taxes, right? It is really, really important to know, because you might sit here thinking that, oh, I need to add them all up, pay taxes on it. No, you're wrong. And we want to go through each one of them to give you a understanding in a very unique way. We go through the government assistance to us, and then sort of talk about what it all entails. All right. So I do want to introduce myself, because I know some of you are brand new to Community CPA's webinar. My name is Ying Sa. I am a passionate accountant. I wouldn't call myself a bean counter, because I've been counting that for 20-some years, and now I'm into a time where I no longer counting it, but I explain it so you can count that better, right? I actually wrote a book last year. I am really proud of it, and I need to get my second one done. And the book is about how to start up a business. It's called Appointment with Ying at 8 a.m., Starting Up a Business. And it's on Amazon, and the audio version is coming out, and just explore. And we also, in our firm, we're really proud of what I am doing voluntarily at the federal level. I'm on the National Taxpayer Advisory Panel, which is a federal level of committee to advise IRS for helping taxpayers. So I am very close to the operation of federal government, how to make IRS better. So you can look to me as your resources if you need, you have recommendations, you need help, and here I am. And with that, I will briefly mention about Community CPA. Community CPA is just a little different from the vast majority of CPA firms out here in the country. And we started back in 1998, and I started that back in 1998 with one client, and today we have over 9,000 clients. And I started that when I was just speaking two languages, English and Chinese Mandarin. And now we have 9 different languages in the firm, and collectively we speak that. And we have 25 staff members, professionals, and each one of us have a language skill that would serve that particular community. So we are proud of that. And at the same time, and we do audit, we do taxes and accounting, and we're really good at sharing. I will tell you that there's not a lot of CPA firms put in effort to be here, share knowledge with you. And we don't hold the knowledge, because we believe that if you got the knowledge I have, you will do better business. When you do better business, you know who is going to benefit? Community CPA will, because I know you will not forget us. You will know where you got the knowledge. You will recommend us, and you yourself will come in to be our client. We welcome you to be our client. And with that, let's dive into what we really want to talk about today. And let me share my screen with you, and so we can get going. While I'm sharing the screen, and I want to warn you that today is a little technical, okay? And because we are going to talk about financial statement, and it's not a fun subject for a lot of people, but trust me, I'll make it so fun that you will love it. I actually working on a cartoon movie related to financial statement. So we give characters to financial statement, and guess who's helping me with that? My second daughter, Crystal, and she is actually just graduated from animation school, so she is helping me putting that together. And I hope that it will come out in a week or so. Now, let's talk about the government assistance. These are the ones that I have in mind. If you have another one, I want you to put on the question and answer. We will answer that. So we got a stimulus check. That is a check to you personally, okay? And that check is issued, and it will not be counted as your income. So from your personal financial statement standpoint, you can think that you got that check, and that is yours. You are not going to fill it into the tax return to pay taxes on that. So the accounting of stimulus check ends right there. But what if you say that, well, Ying, then that's even scary because I didn't even get mine yet. Well, you better figure it out. You should get it. If your income is not high enough for joint couple and is 150,000 above, you lose it. Under, you got it. So you want to look at your income level. Remember, they're basing on your 2018-19. But when we fill up tax return in 2020, that is your last chance to get stimulus check if you didn't get it yet. So you got a 3 try, your 2018, 2019, and then 2020. Of course, you want to submit one that you are eligible. Let's say your 18 income is too high, you didn't get it. Your 19 income is way too high, you didn't get it. But when you file your 2020, your income came down, you will get it. Okay? So stimulus check, that's the end of the accounting. There is no accounting. You get it for free. And now, unemployment. Remember, you got unemployment benefit, right? You got that check from workforce, and it was giving you every week. That is taxable. And that you will receive a 1099 from the government. It's 1099G. And it will say that how much they paid you, the taxable amount, so you will end up paying taxes on that. Okay, that is not, that need accounting. So let's say if you know that you're getting 25,000, and then you also have a little bit of W-2, that goes over 60,000 in total in your household, well, then you have 5 little kids, and they should be qualified for the state subsidized medical insurance, but just because you're over for $10,000, let's say, then you don't have that. So in that case, you want to start planning, right? When I say planning, what do I mean? What I mean is maybe, since you lost your full-time job, you're on unemployment, maybe you should start up a business so that go through the year, maybe your business didn't make a lot of money, even lose some money, then it will reduce your income, right? So there goes your thought of your unemployment benefit, how that all works together with your personal finance. I will tell you that if you have never done tax planning in the past, 2020 should be the year you start doing it. Maybe it can be the last year you're doing it, because after that, your life goes simpler. But 2020, there's no simple cases ever. Everybody is complicated. Everybody is complicated. So now we get into PPP, forgivable loan. And so the PPP is almost like you got the money and 100,000, and you are definitely confused in terms of what should we do. And what if it is not forgiving? What if it is forgiven? What do you do, right? So I will dive into that a little deeper because this one requires us to view the financial statement. EIDL loan, economic injury disaster loan. You may be getting that too. But remember, there's a loan advance, and that portion, and it can be forgiven too. So I want to make sure that we talk about that together with the financial statement. If you have PPP, if you have EIDL, that just tells me that you're actually having a business. So you have a business, so we need a financial statement. Employer retention credit. This is a tax credit, and this is also require you to book it properly on your financial statement. So we're going to go to financial statement, cover that, and that in the way is taxable. But PPP and EIDL in the way can be both. So just keep in mind whatever retention credit taxes you get, and that is in the way is taxable. I'll tell you why do I say in the way. Why do I just say is taxable? No, it is not directly taxable, but it is taxable. And state grants. Someone in our state in Iowa and got the state grant for $25,000, right? You got that money, and do you know that that money is taxable? Okay, so that will come in as your income for your business. So that we will demonstrate that on an example soon. So now let's talk about financial statement. I mentioned at least 3-4 times in the last slides about financial statement. So I want to give you a quick run of what is financial statement. Every time someone throws these big words on you, oh, I need to see your financial statement. And if you are a small business, let's say you have a one-person run business, sole proprietor, then you probably don't even have a separate bank account. You mix your personal account with your business, and when people go financial statement, you're just like, just forget it. I don't know what that is. It's too complicated, and it is not. I just want you to understand and one simple concept related to financial statement. Every time when people say financial statement, you're looking at these 3 things. The income statement, there's another name for that, it's profit and loss, right? That's very simple, right? You just take your income, you take your sales minus expense, come up with a profit, and that's it. And everybody understand that. A lot of people thinking of accounting just income statement. So so many years ago, and I hired an accountant to Community CPA, and so I asked this accountant, I said, after I hired him, I asked him, I said, well, how much you know about financial statement? He goes, if you know minus and the plus and the minus, you know financial statement. So I thought that was such a genius answer, because in reality, it is just a plus and a minus. But that plus and minus are so random. And they say credit, debit, plus and minus, and that is confusing enough by itself. And in the videos I was talking about, I'm producing that little movie, it will actually clarify that. But today, I just want you to remember, and when everybody talk about financial statement, it's okay, you just know it's plus and a minus, but remember there's 3 components: income statement, balance sheet, and a cash flow. And income statement is a plus and a minus, income minus expense, that's easy. Balance sheet is your worth. It's how much you worth, okay? So it is not really something you need to look at every day. It is whenever something happens. For example, you want to sell your business. For example, you want to give a balance sheet to borrow money from the bank. So balance sheet only shows up when you need it to demonstrate how your business is. Because you could be making a lot of money in 1 year, so you have a good income statement. But when you go to the balance sheet, it could be so bad, and nobody wants your business, right? So balance sheet shows up to make you look good or bad. Income statement shows up, it's like a little child. People don't trust that little child yet. So it has to have the balance sheet come out to accompany the income statement. What is a cash statement? The cash flow statement, it is as simple as your bank statement. If you have a simple business, well, people want your cash flow statement, you just give them your bank statement, okay? So really, and there is no secret about cash flow. I don't intend to elaborate that more, and today we just talked about income statement, balance sheet. So now, you see this income statement? I have the income section, then I have expenses section is in blue, right? And then I have a profit loss at the end. So inside of the expenses, I have this cost of goods sold. the only reason I list them separately because in a lot of cases, if you are running a restaurant, you actually have cost of goods sold. What they're saying is the reason the accountant or the spectator, when they want to see your income statement, they want to know which part of the expenses are so necessary and you cannot really run saving. So let's say if I want to buy a restaurant and I look at the income statement, let's say the cost of goods sold is really good. Let's say it's a Japanese restaurant and the income is $1 million. Cost of goods sold is only $240,000, only 24%. So I knew in my mind they're running really nicely on the material side, and maybe they're losing money because they don't manage people right and they are just sloppy managers, right? So as a potential buyer, because I will change the business nature, the business people relationship, I will change the business environment. So I know that, okay, if I can have this much sales and my cost of goods sold is only $240,000, I have $760,000 to play with, yeah, I'll buy that restaurant. So those are the decisions made based on cost of goods sold, because you cannot ignore the material because you can't save much on material. All right, if you do wedges and you need those materials, right? So material is sort of like a fixed cost, the cost that you can't run away. So operating expenses is the one that you really elaborate and what to do, what not to do. Then you have your profit and loss. Next, then we have our balance sheet. And in our balance sheet, and you have asset, you have liability, you have equity. And inside of equity, and we have this profit and loss of prior, which means it's accumulation from the beginning of the business all the way to today. But the equity is made up by roughly 3 components. Number 1 is your initial investment. Number 2 is your current year profit or loss. Number 3 is your past year's accumulation. So if you know these 3 in your mind, you know that how the equity portion plus the liability portion, they should be equal to your asset. From the banker standpoint, when they loan your money, they want to see your liability as little as possible. So let's say if you borrowed your mom $20,000, you are putting that under liability. Then then you want to borrow money from the bank. The bank goes, don't like your $20,000 liability. You already owe money. I cannot give you anymore. And then you run back to your mom. You say, Mom, can you just forgive that $20,000? I'm going to put that in my equity. And I am going to move you out of liability into my equity, so I own your $20,000. I'm not paying you back. Mom probably just going to say, oh, sure, child, do whatever you want. If you want more, I have more to give you. You know, that's what mom do. Why do I know that, right? Yeah. And so now you suddenly don't have any liability. Am I right? So now, and I want to introduce you these concepts because we are going to talk about how these government assistance affect you by numbers. And then you know how to work your balance sheet, work your income statement, and when you come to the bank to ask for forgiveness, that's even going to help you. Okay? Let me go to an example. And in this example, I'm going to use these numbers, but I will very soon switch to a different screen to show you the income statement balance sheet. So we're going to work on 2 examples. This one, it is a 100,000 PPP forgivable loan. The person got it in April, okay? But the person also spent $78,000 on the wages, $22,000 for rent and utility. And the bank, he went to apply for forgiveness, and he got all of it forgiven. Okay, so this would be the number we're looking at. Now, let me go to a statement. So you're here, and I want to show you the statement I prepared for you. So now, this is a statement that I made. This is income statement. You can tell, right? And we have this income. In April, we have this income, and we paid money to the owner, and then total spending is just $8,000, so we left with $819. But remember, we are talking about that $100,000 PPP loan. Okay. Now I want you to follow me and look at this. So on the balance sheet, this is the original balance sheet without looking into this PPP. I'm going to hide it. So this is my original balance sheet. And I have total asset of 1,609 that made up by my cash in my pocket and a checking account. I have this much balance. So my total asset right now is right here. Okay. I did borrow money, and I borrowed $8,000. And on the PPP loan side, I have zero right now because I haven't really put in my PPP. Okay. So I have zero. And that PPP is what we call the long-term liability, and it should be darker color. And so here comes my total liability. My total liability is long-term plus short-term, so I got that. But look at me. I put in $2,580 initially. So this is, remember the equity had a 3 component, remember? So number 1 is what I initially put in. That was that. And net income, what is that? That is coming from my income statement right here at the end of April, okay? So I have that in here. That captures my current status. And my past wasn't so great. I lost a lot of money, and I'm in business for several years already, so I lost total of $9,000. So it's right here. So my total stockholder equity is actually negative, right? And but with my liability, and I got 8,000 minus 6,000, so I have net of 1,609. You see how that matches? How that matches the total assets, total liability, and equity. So this is plus and minus again, right? So the total asset equals to liability and equity, 2, add together. So we got those 2. Now, remember in this example, we're trying to say that the person got $100,000 PPP. When you receive PPP, when you initially receive it, what is your accounting entry? What do? Do you increase your income and increase your bank account? Do you do this? Do you put in your bank account? So this is checking account is only 1,319. Now I came over here. I'm going to add 100,000 because that's my bank. When I add that 100,000 on my bank, do you go to income to add 100,000 here? So this is my income for April, but I'm doing this. Is this what? So this one, if I came over here, you can see that. I can't believe I didn't link it. I'm going to link it. Okay. So you can see that net income increased. See, my balance sheet still balanced. You see that? Because I treated my 100,000 as income, and I increased my bank. Everyone I talked to, I said, you got your PPP? Yeah. How did you do your journal entry? What do you mean, Ying? I already increased the bank. What was your other leg? I don't know. Oh, I put it in as a deposit, so it's automatically income. So that's what people do right now. That's wrong. Let me show you. You need to get rid of your income. No, you didn't have. That's not your income. That is a loan. Okay? So now what you need to do is, it's a loan. So you need to come over here put in 100,000. Oh, 1 million. How I love that number more than 100,000. There you go. Okay, so my formula is not working. That's why it is showing this way. Let me just make sure I make my formula working. All right. See, my two yellow equal again, right? Because I had 100,000 come into my bank, I put in as my loan. So correct. That is such a good way to do it. Okay, folks, that's what you're going to do. Now, remember in our example, 78,000 was spent on payroll, and then the other 22,000 were spent on rent and utility. And when you write the rent check, what do? You actually reduce the bank, right? You're going to reduce. You are going to reduce the bank for, actually it's right here. Let me show you. See how I got 100,000? I reduced my salary. I reduced my rent. So this is salary we were talking about. This is the rent. So I reduced all of them. Then this bank went back to zero because I spent them, right? Now, what was the other leg? Are you going to come over here, goes, oh yeah, salary, no problem. I'm going to document expenses of that. And my rent, oh, no problem. I'm going to find a rent category. I don't even have one. I'm just going to insert one and say rent. So my rent is what? 2,200? 22,000. Okay. Are you doing that? No. Because if you do that and you have a loss of 99,000, sure, that 99,000 reflected in here, and we're still balanced, but your loan did not get spent. So when you go to the bank, you're going to show them that you spend the money. How are you going to show them? You didn't spend, it is still right here. So what needs to happen is you cannot go to income statement. You need to come out of here, get rid of your expenses, so your income statement didn't even change with PPP loan. And you come over here, my dear, and you will reduce. When you reduce your bank, you will take it out of your loan payable. So you reduce by 78, you reduce by 22,000, then you get into zero, okay? Then what happened to here is it will be minus. So this is our total loan, and we paid out 78,000 on salary, paid out 22,000 on expense. See, your loan is gone. Okay, so this is how the PPP loan is being used. And of course, you may say to me that, well, Ying, what if what if I only got $50,000 loan forgive, and the 50,000 become a loan, stay on my book. So let's say for the 100,000, let's say we got denied for the 22,000. Okay, we for whatever reason the bank goes, no, you can't. So we got denied. Now we have 22,000 left here, right? Because we didn't get to use it. The bank says we cannot deduct that. So okay, fine, I put that one back. And here I also have a 22,000 left. Am I? Because it's still a loan. This loan gonna stay on my book. But you know what, Ying? I actually did pay rent, even though it was not forgiving, but it was my expense. I really did use it. I used it, okay? So now what needs to happen is you are going to put in $22,000 rent as your expense, all right? You don't have income because that's a loan. You don't increase your income. But over here, you used your rent already. So I delete that. So look at that. Right now, you had more losses because you borrowed money to pay expenses. That's not your income, but increases your expense. So if you use that to report taxes, deducting your other income, totally legit. You should do that. You should do that. Then I know someone was saying to me that, Ying, if you say that, then I'd rather just not to go through the bothersome process, and I just gonna have them be the loan, so I don't even have to work on forgiveness anymore. I'm okay because I can deduct it. It's not the same. Okay, let me explain to you. When I have a loss of $21,000, I can deduct the income by $21,000. How much cash did I save on taxes? It's $21,000 times the rate you're paying. Am I right? So let's say your paying rate is 20%. That means $4,200 tax saving. But if you can make it forgive, and you got $22,000 cash saving, it's not the same. Don't get confused. I'll say that one more time. When your PPP is not forgiven and you borrow the loan, you will still have to pay the loan back. But the money you borrowed, you paid expenses, yes, deductible. Okay? So you have a loss for $21,000 in this case because the PPP loan of $22,000 is not forgiven. So now I have $21,000 loss. I take it to my tax return. Let's say my rate is 20%. I can only reduce this much out of my income. So I really just saved 20% out of 21. So that's $4,200 saving. Of course, I still saved money, which is good. But if you got that forgiven, you don't even need to pay the $22,000 back anymore. In this case, sure, you save $4,200, but you have to pay that back. That's your loan. It is not done. You have to figure out $22,000 cash to pay it. All right? So, sure, so your total real saving is actually right around 16. Your real loss is $16,000 cash because it's $22,000 minus $4,200. Right? So, with that, I want to make it a really high-level summary. If your PPP loan is not forgiven, becoming an item on your return, on your balance sheet, so it is a loan, the amount of tax saving you have on here is your loan amount times your tax. So that is the amount you saved, but the rest of it you have to pay it back. Not a good deal. The good deal is you follow the rules, getting that completely forgiven, just like right here, and it will be a 0. And then here we will put in back what we can be forgiven. And so our balance sheet is going to look like this. We're going to go back here, take away that because the loan is forgiven, so we cannot count on the expense again. It's already paid by the bank, right, basically. And so our income statement has no change related to PPP. That is the best place to be. So I want you to know that if you got a PPP, your goal is your income statement did not get impacted at all by the PPP. And then here, your PPP balance is 0, and nothing, it looks as if you never had it happen, okay? But of course, it saved your 2-month salary, saved you some of the rent, but it doesn't even go into your income statement at all. It's outside of your income statement, and it got digested inside of your balance sheet between asset and liability, okay? So I actually do see quite a few questions. I have one more example to go, but I want to answer these questions. Then we wrap up with the last example. Then we really honing home with what we're trying to learn today. Okay, so I can't help. Okay, someone said, "Can you be my mom?" Yes, I want to say whatever. Yeah, borrow, forgive. Everything is forgiven, right? For the first 20, should we say for the first 18 years or 25 years? Oh my God, 35 years? No. Let's hope I don't get there. I have 3 of them, okay? I don't want them to end up that way. And for a sole proprietor, do you need to show the bank the balance sheet in order to get loan forgiven? What a great question. Let me tell you that depends. So some of the banks do ask you, and I don't know, I already see the government is asking for that. And one of the programs here in Iowa, if you want to apply to qualify for that program, they want to see your balance sheet with PPP loan on it or not. So that's already a indication of people cares about this balance sheet, okay? So if you are sole proprietor and hopefully you only have one payroll, I really hope that if you file Schedule C, you never really had a balance sheet. So I'm hoping that the lender not going to give you a hard time and just really want you to do a professional financial statement. But underwriting is kind of stipulated by bank themselves. Depends on which bank you're working with. They could get flexible. They also could be a stickler to the rules. And it largely depends on where you get your loan, PPP loan. If you get a PPP loan from one bank, you cannot go to another one to get forgiven. That's why I always recommend our client that to go to the bank to ask for what they need first before you submit anything. And when you submit, it needs to be a final product. And in my last webinar, I was telling people that my experience, okay, sometimes our small business is really not understanding the underwriting process. So this is a real example. And what they do is they submitted one thing to the bank, say, is this good enough to borrow money? The bank goes, oh, no, this is not good enough. They went back, they make another one, they come back, is this good enough to borrow money? The bank look at it, goes, wow, how come your income changed? And that's still not good enough. And then they went back and they come back and is this good enough for your money? So after 3-4 times, they were actually got kicked out of the bank because the bank believes that they're fraudulent. And then by the time they came over to me, explained what they were doing, and it is totally not the case. But I am just saying that not everybody understands small business. Not everybody understands what kind of thinking process we have. We're just not bean counters. We're not accountants. And we don't really know. And you ask me for balance sheet, I think it's just my bank. So, but you have to know in order your business to survive, and I say that you meet their requirement. And we cannot say we're small, so we should be giving a easy way to get out. No. And of course, in business world, the play field is equal. So they don't have to be sympathetic to you. And other than those nonprofit organizations, they are getting funding to play that sympathetic roles. Then you get that help, right? So just be sure that you submit that one. You submit your application carefully and vet it through the system. Know that you will get forgiven before you go for it. Which month does the bank count the deposit as income? Which month does the bank count the deposit as income? Actually, don't quite understand that question. I would say that if you receive the PPP loan, say in April, and you don't count that as an income, you count that as a loan, right, on the balance sheet. But as soon as you end up, the bank says, oh, July 1st, let's say, and the bank came to you, goes, hey, you got all forgiven. And then you know that you should stay on the balance sheet and don't touch income statement at all. But if the bank goes, hey, you have half of forgiven, half not, and then you leave half on the balance sheet. So for the PPP loan, should never ever land it on the income. It is either loan or it's forgiven. Forgiven means just running, just came out of the loan, is not standing, not there anymore. So if it is forgiven, and you see that this number, it will be 0. Not 100,000, it should be 0. Okay? All right. So let's just go here. I have another question. Can you show how it works in QuickBooks when you pay things that need to go against PPP? All right. So I don't really have QuickBooks pull up here, but let me explain to you. When you write a check in QuickBooks, and the on the bottom of it, the distribution, like the account, is actually already listed for you. If you have let's say if you pay garbage bill, it probably already went to sanitation. So you need to look at that GL account. You want to change that GL account to PPP liability account. Normally it's a 2000 number account. So the 4000 is income, 2000 is liability. That's how generally majority of accountants are doing that. So make sure you change. When you write a check, you go ahead and write a check, but go to change that, the garbage, the professional fee, change that to PPP account. That's all you need to do. Okay? All right. So I am going into my next slides. I want to show you. So this one, I'm going to use this one as an example to play with that spreadsheet again. So I'll use that to wrap up today's webinar. Jesus lawn mowing, okay? He received $8,000 PPP, $4,000 forgiving, but the other 4 did not. Jesus used the $4,000 he did not get forgiven. He actually used that, bought a truck. But the other $4,000 he did pay on payroll. And he received unemployment benefit, and he also received $25,000 state grants. What is Jesus' financial statement looks like? Let's go. All right, so now let's come to the income statement. So remember, in Jesus' example, I said that he received the $25,000 state grant. That state grant is taxable income, so it will be added in here. So instead of whatever he got, we're going to add $25,000. But when I deposit the check into my bank account, treated that as an income, my balance sheet for sure needs to change, because I need to put in that $25,000 as my income on my bank account, right? So this is how it works. So look at this. So we got our balance sheet still balanced, because obviously I got more income, and because I put in $25,000 in here, so I got $25,000. So that is the treatment for the state grant. Now, he got $8,000 on PPP. So $8,000 right here. And remember, he used it $4,000 for salary, right? So I cannot put my salary expenses over here for $4,000 because it's PPP. So I'm running against PPP. So that's my $8,000 here. So I will minus $4,000. So that's my payroll. Okay? So after I did my payroll, and obviously I left with $4,000 here. Am I right? And because I paid it out, so the bank need to reduce, right? The bank is no longer have that money, and I need to reduce $4,000 salary. And right here, I reduce because I paid out $4,000. So that's my bank balance, right? My bank balance is this. I only spent $4,000. I still have $4,000 here. But remember, that $4,000 is forgiven, so it's gone. We don't put $4,000 in the income statement because that's a salary. We use up PPP money to pay the salary. That's it. Evaporated, right? But the other 4,000 was not forgiven. The other 4,000, and in here, actually, I forgot one step, folks. Allow me to pedal back to add the $8,000 in here. Remember, right? Because you got an $8,000 PPP, so we book 8,000 here and 8,000 on PPP loan, but we use 4,000, so PPP loan now is 4,000. Okay, so with that, and I want to make sure I was checking a balance sheet just to make sure I balance. And now in here, remember, he used this 4,000 to buy a truck, right? So we are right now, this 4,000 is a loan still outstanding, but he spent that money for a truck. That means we are losing the other $4,000 cash. Am I right? Right? You saw that. You saw me taking, folks, here, take a look. Okay? I added the $8,000 because that's a PPP loan, and I minus the salary because we were paying salaries. Now I also paid out $4,000 for the truck. So now here I need to add a fixed asset, don't I? Because, oh, it won't let me do that. Okay, I'm just going to put that in here. Truck. That's my fixed asset. My fixed asset right now, it is going to be 4,000. Am I right? So my total asset, it is these two numbers add together. Current asset plus the 4,000, that's my truck. So this 4,000 is offsetting between here and here. Because I took the cash out, I add the truck in, okay? And let me just, I can't delete. Because I'm sharing screen, I think it won't let me to do that. Okay, that's fine. It won't let me do that. So this is my total asset. I just want you to know this is my total asset. And then my total asset coming over here, did you see that is equals to my total liability plus my equity? And look, I still have this loan here. I didn't pay it back. It has become a loan. But take that, no, put this one yellow. Okay, folks. See my balance sheet balance, now I have that 4,000 right here. That is my PPP loan. And here, because I bought a truck, because Jesus bought a truck, so there is no expense here is asset. But if someone preparing you for income statement for tax purposes, okay, tax basis income statement, then your small tools, your truck would come in here, then your 4,000 is here, okay? But that is the depreciation, things coming in, they will reduce it. On the tax form, it will come into play. Am I making sense to you, or is a little bit over what I am explaining here? So basically, the asset and the liability, I'm going back to my form. I want you to see this, okay? Okay, so basically the asset, this $4,000 asset for Jesus' truck, okay, for tax purposes, it can come here to be a expense. That's why you see I have a blue boxes on income statement. Then on the balance sheet, this is blue. What does that mean? That just means two of them are the same. The only difference is in the income statement, that expenses are very quick and short-lived. But on balance sheet, your asset is a long-lived asset. There are things that you hold on for more than 1 year. Things that you see and you touch it and you don't lose it. Not like the food you eat is gone, right? And so there's a lot of expenses come and goes. But asset is also expense, but they don't come and go. They come and stay. So they are expenses, just has a different lifespan. That's why they're sitting on the assets. I really, really appreciate all of you coming in to see me, and we hope to see each other again on Thursday and Saturday, and I'll talk to you again. I hope you learned something today. Bye-bye.